Welcome back, traders. John Caruso here for March 12th. Another edition of Rolling Trades. I haven't been on here in the last several weeks here, so it is good to be back. We've got a slide deck prepared for everyone. We're going to kind of do a little bit of a mini dive into growth, inflation, labor, and of course, Fed policy. We're going to try to tie it all in to what the next move by the Fed is going to be. So without further ado, let's jump right into the slides here. The executive summary, the U.S. came into 2026 with moderate but cooling growth estimates. Q4 2025 saw a year-over-year GDP reading of 2.2%, which is a deceleration from Q4 2024 of 0.9%. Inflation has seemingly stabilized coming into this year, post-pandemic between 2 to 3%, but that's likely going to get a boost in upcoming reports with the exogenous oil price shock we've recently seen. Labor has largely been defined as a no hire, no fire landscape. However, with last Friday's unexpected drop of 92,000 jobs and seemingly inescapable downward revisions to prior months, the labor market is exhibiting classic late cycle behavior. Unemployment rate ticked up to 4.4%. We're going to watch that carefully. I think if we cross 4.5%, we could race to 5% in relatively short order. Labor force participation rate also declined to 62%, and long-term unemployment averaged 25.7 weeks. That's the highest since 2021. And to kind of tie that all in, summarize the executive summary, the economy is exhibiting a nasty bout of stagflation over the very near term. We do have that forecasted out over the next 2 quarters. So I think the length of how long these geopolitical concerns remain in the headlines, I think that is the biggest concern. I do firmly believe that a large part of this war being fought right now between the U.S. and Iran, as well as Israel, is being fought on the screens right now. And you see that in the price of energy. And you see that in the reversal that we've seen in the 10-year yield now from bearish trend back to bullish trend now. And we kind of tie that into risk assets and what could be directly ahead. I certainly do believe that this is not simply a kinetic war, but it's also a war that's a war of attrition for economies. GDP growth, 24-month look back, real GDP grew at 2.8% in 2024. We did see that slow to 2.2% in 2025. Okay, we saw a modest slowdown. We were kind of expecting that. 2.2%, we're kind of falling right back into the baseline. You can see here on the chart that I have highlighted, this was during the pandemic, and then we saw the post-pandemic boom, and now we're kind of settling back into the medium range between about 2 and 3%. But where this goes next could largely depend, once again, on the duration of this stagflation call that we have at the moment. Let me go back here. I missed one. Another look at GDP, 24-month look back with the accelerations and decelerations on a Q-over-Q basis. When I look at the base effect from Q4 2025, 2.2, we slowed 0.9% on a year-over-year basis from 3.1 to 2.2. So we did see a pretty fairly large deceleration in growth. However, once again, still above 2%. Nothing to really sound any alarm bells off coming into 2026. PCE, personal consumption expenditure. Of course, this is 70. The consumer is 70% of the economy. We are seeing coming into 2025. We did see a clear deceleration in personal consumption expenditures, and you start to look ahead. We will have a PCE reading out tomorrow, but much like the CPI number yesterday, it could be pretty non-material because none of that data has factored in the geopolitical risks and, of course, the energy price shock that we've recently seen, and how that is certainly going to affect the consumer going forward. So, pretty non-material data likely coming out tomorrow as well. PCE remains the main driver of GDP, but is now trending softer amid selective behavior. Flipping over, WTI crude oil. You can see the blowout there on the chart. Crude oil, it says here, up 52% year to date. That was as of 2 days ago. Coming into this morning, we were up 65% year to date. Geopolitics remain front and center as oil prices blow out. A sustained oil price shock is going to afflict damage on the U.S. consumer, potentially crippling. A sustained move higher will put pressure on rates, inflation, and we believe ultimately risk assets at some point down the road. Critical context, the Iranian conflict. Persian Gulf shipping lanes remain disrupted. Oil and gas prices are soaring. Energy costs going to fuel inflation pressure and potentially slowing growth down the road. The chart that I have up there, that is tanker traffic through the Strait of Hormuz. As you can see right over here, we have ground to an absolute halt. We saw a big boost going into the conflict. I think that was probably insiders trying to sniff something out. Something was coming, some geopolitical tension, and then here we are dropping to pretty much nothing on the chart. So no activity happening really in the Strait of Hormuz right now. And of course, that's 20% of the world's oil flows through there. Not only oil, but LNG as well. 20% LNG, 20% of oil through the straits. So as you can clearly see, that's going to be a big battleground during this conflict. Flipping over, CPI, Consumer Price Index. We saw that number yesterday, 2.4 versus 2.4 versus 2.4 previously. Well behaved, but pretty much non-material. We did see an acceleration month over month, up 0.3%. Year-over-year core came in nice and neat at 2.5%, still well behaved. But of course, looking over the next 30 to 60 days, that number is likely to tick towards 3%. Clearly, the risk is skewed to hotter inflation readings coming down over the very near term. We're going to do a breakdown here. The well-behaved inside of the CPI number, shelter and rent, slight increase of 0.1%. That's the lowest acceleration in 5 years. New cars unchanged, used cars down, decelerated 0.4%. Core services moderating at 0.2%. The misbehaved groceries up 0.4% in February. Clearly a big expense for consumers on a monthly basis. Gas prices, another massive expense for consumers on a monthly basis, up 0.8%. And this isn't even factoring in some of the moves we've seen in agriculture, and certainly not the move that we've seen in gas and oil prices over the last 2 to 3 weeks. Transportation, medical care, both showing notable accelerations. Again, big expenses for the consumer. To summarize that, while the February report showed stabilization with some positive signs, housing, the Iran conflict has fundamentally altered the near-term trajectory of inflation. The March inflation data will likely show significant acceleration driven by energy costs and potentially further pushing away from the Fed's 2% target. Remember, the president has called for meaningful rate cuts over the last year, really. And this data certainly is not going to help the case to be made for significantly lower interest rates, nor is the affordability argument by Main Street America. And we're going to get into labor trends here, and this is kind of where the catch-22 comes into play for the Federal Reserve, because last Friday's jobs data on March 6th, we saw a notable decline in payrolls. Negative 92,000. That's the worst monthly job loss in the post-pandemic era. Outside of government shutdowns, unemployment rate ticked up to 4.4. Once again, I mentioned we crossed 4.5. I think we can get to 5% relatively short order, so we got to keep a very close eye on that. 3-month average, just 6,000 jobs on a month-over-month basis. That's factoring in the revisions. I mean, that is stalling speed right now. We know for a while, for the past 6 months, we are largely in this no hire or low fire zone, and it looks like we may have crossed the Rubicon here last Friday. Participation rate also dropped to 62.5%. The chart that I have up there, you can clearly see the vicious cycle of labor. You get the oil shock right here. That starts to hit the consumers in the pocketbook. They start pulling back on spending. Business revenues fall. More layoffs come. Job losses come. Rinse and repeat. And the losses could quickly pile up. I did see on Kalshi today that the odds of a recession this year, 2026, that virtually nobody was talking about coming into this year, have now jumped to 31%. And the longer this conflict goes on over the Middle East, those odds are going to continue to move closer to a coin flip. And virtually nobody had that on their bingo card coming into 2026. So clearly, you've got to pay attention to what's going on in energy, what's going on in labor. These are the big factors that we really need to pay attention to. And then when you tie that all in to Fed policy and how will the Fed respond to this? Well, we already know that inflation is likely to tick closer to 3% than 2%. The Fed's missed their inflation target now for the past 7 years, or not 7 years, but for the past 4 years. Um, they can't raise interest rates if inflation is back towards 3%. But at the same time, you've got a deteriorating labor market, which would actually reinforce them to cut interest rates. So you can see the catch-22 that they're in right now with about a stagflation. And I have often said over the last year that when it comes down to it, when the labor market, we finally see the whites of the eyes of the labor market, which I believe we are seeing right now, the Fed will acquiesce. They will acquiesce to higher inflation to save the labor market. I don't think they have a choice in the matter. You need GDP growth to finance the debt, the nearly 40 trillion in debt that the economy is in right now, paying over $1 trillion in interest expenses on it. You need the GDP to finance that. So you got to be very careful as to how they walk the line here. But you can't let you can't let labor go. You need the GDP, and I do think ultimately it's going to result in higher inflation to come. So in the longer we see elevated inflation, that's going to be potentially absolutely crippling for the economy long term. So very scary place that we could be embarking in here. Up here, you'll see the Market Pulse. I rate the Market Pulse on a daily basis. It is a free newsletter. Just ping me at jcaruso@rglfutures.com or john.caruso@stonex.com. I will add you to that market insight list. Feel free, jump on board, follow along, see how we're making moves and recommending moves with client portfolios. I'm very high touch. I do work very closely with our clients in terms of helping them manage risk and set up their portfolio to try to capture some of these wild moves that we're seeing right now. I've been doing this now for 22 years. You could argue that I've been waiting my entire career for some of the market moves in the commodity space that we're currently seeing right now. So very exciting time, very dangerous time in markets. If you don't know what you're doing, feel free. You certainly need to get together with a CTA or an investment professional like myself, who can certainly help you out in terms of managing risk. So once again, pleasure to be here with everybody. I'm John Caruso. I'm going to leave it at that. Great to be back. We will see you again probably in the next 2 weeks. Everybody, good luck. Great trading. We'll catch you back here next time. Take care.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.